Good morning, good afternoon, or good evening. Today, our team is comparing Home Depot and Lowe's as potential investment opportunities. Both are major U.S. home improvement retailers, and because they operate in the same industry and sells very similar products, they make a strong side-by-side comparison. Our goal is to evaluate not just which company is bigger, but which company appears to offer the better mix of profitability, stability, and investment potential. Both Home Depot and Lowe's make money primarily through large scale home improvement retail, but there are some important differences in how they are structured and where they are trying to grow. Home Depot model combines large format retail stores, e commerce, installation services, and tool and equipment rental. It serves three major consumer groups: the professional contractors, the do it yourselfers customers, and the do it for me customers who purchase the installation services. Operationally, Home Depot ended fiscal 2024 with 2,347 stores, and about 13.7% of those were outside the United States, mainly in Canada and Mexico. From a reporting standpoint, its core geographic operations are grouped into one primary segment, while the recently acquired SRS Distribution business is reported separately or within the other segment. The company is also pushing an interconnected retail model that ties stores and online fulfillment together. And online sales is an important segment which represents 15.1% of net sales. The SRS acquisition also added a major branch network, which over 780 SRS branch locations at year end. Lowe's Home Improvement uses a very similar basic model, also centered on merchandising sales, installation, and home services, and services to the do it yourself, do it for me, and pro customers. But Lowe's is more US focused and reports its home improvement operations as a single operating unit, which makes its structure a little simpler form for a financial reporting accounting perspective. Lowe's ended fiscal 2024 with 1,748 stores and outlets in the United States and about 195 million square feet of selling space. Strategically, Lowe's has updated what calls its total home strategy, built around five pillars: growing pro penetration, accelerating online sales, expanding home services, creating a loyalty ecosystem, and improving space productivity. So, overall, both companies are similar retailers, but Home Depot is larger, slightly more international, and more acquisition driven, while Lowe's Home Improvement is streamlined and focused on improving its existing US based platform. For the income statement, the first thing I want to highlight is that the two companies had very different sales patterns in the most recent fiscal year. Home Depot reported net sales of 159.5 billion dollars in fiscal 2024, up from 152.7 billion dollars the previous year, which is an increase of about 4.5%. At first glance, that looks like strong growth, but the important detail is that management says most of the increase was driven by the SRS acquisition and by an extra 53rd week in the fiscal year. The report notes that SRS contributed about 6.4 billion dollars in sales, and the extra week added about 2.5 billion dollars, while comparable sales were actually negative. So the reported growth was real, but much of it was not organic, demand driven growth. Lowe's tells almost the opposite story. Lowe's reported 83.7 billion dollars in net sales in fiscal 2024, down from 86.4 billion dollars in the previous year, which is a 3.1% increase. Management tied that decline mainly to the weaker comparable sales and fewer comparable transactions, especially in discretionary do it yourself categories. So, Lowe's revenue performance reflected the softer home improvement environment more directly. This matters because both companies were operating in a tougher macro environment, but Home Depot revenue was supported by acquisition and calendar effects, while Lowe's revenue showed the underlying pressure more clearly. That distinction is very important when we think about sustainability and future growth with profitability. Now, speaking of profitability, looking next, both companies remain highly profitable, but both showed signs of some margin compression. So, the big takeaway is that both firms stayed profitable and held gross margin near 33%, but both saw pressure from operating expenses. Home Depot earnings decline was smaller, but Lowe's still remained operationally comparable despite its smaller scale. That supports the slide point that Lowe's is not necessarily a weak operator just because it's smaller. The clearest structural difference between the two companies over this period is merger and acquisition activity. Home Depot completed a major acquisition of SRS Distribution in June 2024. Total purchase consideration was about $18 billion, made up of approximately $17.7 billion in cash plus $321 million in common stock. From an analytical standpoint, this acquisition gives Home Depot more long-term growth potential with the pro customer, but it also introduces integration risk, more exposure to construction and specialty trade cycles, and greater balance sheet sensitivity because of decreasing goodwill, intangibles, and interest expense. So, Home Depot's strategy looks more aggressive and potentially higher return, but also comes with a higher risk. Lowe's did not make a comparable acquisition during this period. Instead, its transaction story was mostly about continued effects of its earlier Canadian retail divestiture. Lowe's have been simplifying the business, focusing on its U.S. operations. This lines up with the broader total home strategy that helps explain why Lowe's appears cleaner and less complex from a merger and acquisition standpoint. Home Depot used acquisition to drive strategic expansion, while Lowe's used divestiture and simplification to sharpen its focus. The overall home improvement industry is driven by two major types of demand. The first is large scale renovation and remodeling. These are purchases tied to kitchen remodels, structural improvements, and commercial and contractor based work. This side of demand is more cyclical and more sensitive to mortgage rates, housing activity, consumer confidence, and the broader economy. The second is essential home maintenance. This includes plumbing repairs, roof work, appliance replacement, and routine upkeep. This type of spending tend to be more resilient because homeowners often have to make those purchases even in a weaker economy. This distinction matters because it helps explain why companies in the same industry can have different risk profiles depending on which part of demand they emphasize more heavily. Although Home Depot and Lowe's sell similar categories of products, they have historically emphasized slightly different consumer groups. Home Depot has been more focused on the pro customer, meaning contractors, remodelers, and professionals making larger project based purchases. That tends to drive larger transaction sizes and higher revenue per store, but it can also make performance more sensitive to the cyclical changes in the housing cycle. Lowe's has traditionally been more associated with homeowners and the do it yourself customers. These purchases are often smaller, but they may happen more regularly because they are tied to everyday maintenance and repair. One of the clearest differences between the two companies is just simply scale. Home Depot generates about 159 billion dollars in net sales, compared with roughly 83 billion dollars for Lowe's. It also reports about 14.8 billion dollars in net income, versus around 6.9 billion for Lowe's. In addition, Home Depot has a larger total asset base, higher market capitalization, and more employees overall. So, from size perspective, Home Depot is roughly 2 times larger than Lowe's across most major measures. That said, scale alone doesn't automatically make it a better investment. Despite Home Depot's much larger scale, the two firms are actually close in profitability. Home Depot's profit margin is about 9.3%, while Lowe's is about 8.3%. Their earnings margins are also very similar, with Home Depot around 16 to 17% and Lowe's around 15. Home Depot appears to sit more on the higher risk, higher return side. One reason is it is greater emphasis on professional customers and project-based spending, which can be more cyclical. Lowe's appeared more stable by comparison. Its strategy relies more on organic improvement, like improving store productivity, supply chain efficiencies, and the consumer experience, rather than on major acquisitions. And we can see in the both companies' performance, Home Depot EPS declined, while Lowe's stayed stable. And on the revenue side, Home Depot reported stable revenue growth, while Lowe's reported the same. So both companies were affected by the housing slowdown, but their results were shaped by different strategic choices. Home Depot's recent growth looks stronger on the surface, while Lowe's recent earnings pattern may look a little more resilient once we adjust for acquisition and timing effects. Based on our analysis, our recommendation is Lowe's as the more stable investment opportunity. There are a few reasons for that conclusion. First, Lowe's appears to have somewhat more stable customer and demand profile because of its heavier tilt towards homeowners and essential home maintenance. Second, its strategy relies more on organic operational improvements and less on large acquisitions, which lowers execution and integration risk. Third, Lowe has an especially long history of returning capital to shareholders, including 54 years of dividend increases. Thank you.